I plan on bouncing back and forth between the presentation itself and our charts so we can go through some analysis for everybody. And that, I think, let's get that out of the way right now. So I'm going to go over here to desktop sharing. All right, so this is the S&Ps, and we have our monthly pivots. As you can see, the market has just about traded, and they're making real neat issues, the fact that we traded above the March 27th high in the S&Ps. Interestingly enough, I know that they're making a deal that we traded above it yesterday, but we closed back. Notice that there is no generated sell signal up here yet, meaning an orange triangle. That would be for those clients that have Thinkorswim, and for the quality and integrity of tonight's presentation, I'm only going to have Genesis up because it has also our seasonal trend indicator up, so I wanted to share that with tonight's audience so that we could see, when I take a look at the markets, I want to look at a few things. Number one, we do have a generated, and the market has been in a PPS buy signal on a daily basis since July 27th. Now, let's take a look at the weekly. The market has actually been in a weekly buy signal, as you can see with this green triangle, since June 22nd. So there's a few things that I look at when I'm analyzing the market here, or how I see things. First off, typically the market does move from on or about June 22nd. It rallies a bit, pulls back, and then we see strong rallies going into the third to last week of August. The market did rally, and there's two ways that you could look at a correction: down and sideways. And so the market did adhere to that type of sideways corrective phase in the marketplace, and has thus rallied. So when I say, when I start asking myself, does the market have legs to sustain this move? The first thing I say is, in order to figure out where a market might go, I ask myself, well, where has the market been? So where are we in respect to year-to-date movements? So if you think that, from a year-to-date perspective, we are up and almost went 13.8% year-to-date gains in the S&P 500. So can we see a continued move to the upside right straight away? And the answer, in my experience, is I think that we could possibly re-challenge the highs. We don't have a sell signal quite yet, but I don't think it's sustainable right now, not in this time frame. Number one, I had the news on earlier, and they were making a thing about Jackson Hole, Wyoming, the big event that will be coming up. And truthfully, if you listen to some of the stock earnings and the guidance, like John Deere, headwinds in Europe, a lot of people that had reported it's mixed. It's not that you have an 8-cylinder engine and it's firing on 4 cylinders, so to speak. It works, but it's not working well. And so I don't think that Ben Bernanke is going to say anything different between now and September 7th. And most of you probably, if you're looking ahead, know what September 7th is, and that's the monthly unemployment report. Apart from that, I don't think the Fed is going to have any different stance now versus then, unless there's a dramatic decline in jobs or more Americans unemployed, and a significant number at that. So I don't know if they come in with a quantitative easing. I don't know if they come in with lowering interest rates to a negative real rate. There's not much the Fed can do in that regards. They can still add liquidity with Operation Twist, and we saw today the bond market reaction. We reacted very strongly today with the FOMC minutes that were released. So the minutes that were released today, I don't think there's going to be much to change by the time Jackson Hole, Wyoming summit meeting comes out. So that's one. Next is of course, the obvious. It's political. It's an election year, and we haven't even really begun to see significant levels of jargon, mudslinging, and back and forth between the Dems and the Republicans. And that, I think, that uncertainty and the poll results of who's going to win and who's not going to win, we still are faced with that. And I'm not getting into any political beliefs in the presentation. That's not my job, nor has any political party ever affected my long-term career in the markets. The economy will continue to move no matter who's elected president, but we need to know what stance and what measures might change from a congressional or from legislative changes. So the Senate is going to be, in my view, fairly important. And that's just how I see things. And it has been since I started in this business back in 1980. When I take a look at the markets, I say to myself, all right, we're at a predicted pivot resistance. I get that. The market's also trying to test the old highs that we had in March, and I see that as well. I also like to look at the advanced decline comparative ratio in the S&Ps. Most people only see the NYSE. And it's interesting how the market is just tapping into newer highs in the S&Ps, but notice that the advanced decline, or the amount of stocks that are in the S&Ps, are not near their highs or taken out newer highs. On balance, volume is kind of stalled. The rally did have a little bit of legs, as you can see. And here's the most probably prominent feature that I would share with you, is that the market has a tendency in all years. And if you recall back in the Bush-Gore election with the Chad problems, if you look back at when we had the last election, McCain and Obama, if you go back on any election, there's still going to be a lot of uncertainties going into this time period. And so for 13.8%, it's pretty rich environment. There might be a little bit more upside, but in here, I think looking at the fact, and these are facts, that the advanced decline, it shows that there's not as many stocks participating with this rally. Coming into the fact that from a seasonal perspective, we start that decline fairly rapidly, that to me is a little concern. For many of you who have taken my course before and you know what the low close doji is, we had a doji today, of course. If you look at today being Wednesday, today, look what we did. We opened at 1275, we closed at 12.5. If you look up here at the top header, you'll see the prices as I scroll over with my pointer. In other words, we opened at 1412.75, we closed at 1412.50. We formed another doji today. This was the first doji, and in my work, it's important that after 3 time periods, if we close, and the low being 1409.5, and so you may have gotten it, if you're signed up for my tweets, this morning I said, listen, if the market closes below 1409.50, and that's a low close doji would form, number one, it would also have generated on today's action, it would have generated a daily sell signal on a close, so we would have had an indicator sell signal and a low close doji, and as you can see, it did not happen. That means that 1, 2, 3, by the end of today, but we also have another doji, we could linger up in here, really not go anywhere, but I'm thinking that we might try to test this high one more time. But I do believe that the monthly resistance will be respected in the S&Ps. The fact that we have not seen a lot of participation or new breakout highs confirming this move with the advanced decline levels, I think that's important to keep in mind. That's just the S&P 500, all right? So if we take a look at other indices that we like to work with, like, for example, the Russell. The Russell has made significant strides. We see the breakout, as you can just focus in on the highs here of July. We did take out the highs in July, but we did not with the advanced decline. And notice that the rally on balance volume in the small cap sector is not as strong as, in fact, it's still in a downtrend. So let's take a look at the advanced decline combined with the volume levels. We see the market coming up in the last week, really moving significantly in the small cap as represented by the Russell 2000. So for stock traders and ETF traders, if you're looking at the RUT or the IWM. It's the same function. It's based off the Russell 2000. This is just the futures. So when I look at the Russell 2000, and that's the AD comparative ratio on the Russell RT here, notice that we definitely are not seeing a cumulative move in stocks, all stocks, or the majority of stocks, confirming this price move. So one of two things are going to have to happen. Either people are going to have to start dishing out some cash right now and start buying all the low-end stocks and start buying small cap stocks and start buying like the Hewlett Packards and the Dells and all the dog stocks that haven't moved. Because remember, in really bullish times, when the blue chips and when the high quality stocks move, everyone just buys anything and get their hand on. And you know, quite frankly, it's a little disconcerting to see the market making higher highs and the volume levels are not there. And everyone, you might hear talk about that in the news about low volume, and we get that. But what you might not hear is that there's not as many stocks participating in the rally, which means these cap-weighted indices are just moving on a few big names. So with that said, unless the overall market starts to become more or more stocks participate in this rally in the next couple weeks, and I would gather to say the seasonals are going to kick in, which indicates price levels to the downside. So one other sector that I wanted to make focus in on is the NASDAQ, because the NASDAQ, I mean, really, with the weight that Apple has had and the big movement that we've seen in Apple. Now, this is a weekly chart of the NASDAQ 100, and as you can see with the on-balance volume, we really have had more of a sustainable, which is a contradictory of what you may be hearing in the news, that this rally is on light volume. But when it comes to the NASDAQ on a weekly basis, we have broken out the volume levels on this rally, and so one could say, well, maybe that's sustainable. But here's what I'm more interested in. The fact that we are breaking out and the amount of stocks is not moving in conjunction. It's not participating. So one of two things have to happen. Either stocks have to participate with the index, or the index is going to move back down in the direction with the balance of the market. So that the fact that we're coming into a seasonally weak period, the fact that stocks have shown a tendency to move up in August, into the third to last week of August, the market has been adhering to its seasonal tendencies. So a market that has been in sync, I tend to believe it will remain in sync with its typical seasonal tendencies. So that means we're probably, no matter what happens, we probably are due for a correction, and now it's imperative to start saying, all right, do I look at specific strategies to hedge current long positions, or do I put some risk capital, and how can I capitalize on a market? The next question we have to ask ourselves is, how far down can the market go? And so, you know, when we look at if the market just pulls back in the NASDAQ, I'm going to just speak NASDAQ, if we just get back to the highs that we saw in July, which, quite frankly, if you think about it, we had one breakout at the end of that week. This is the first breakout week, second, third. We're only 3 weeks into a breakout. You know, what took 3 weeks to go to the upside, it could take 1 week to come to the downside. So let's say, for example, if you had a 5% move, we would be somewhere around this area in here. So a 5% correction is not a big deal. 8% correction, you know, if you figure 8%, you'd probably be 2580, 2600. I don't think that that's really a bad thing. You still maintain an upward trend bias. So no matter what happens, if the situation in Greece, the situation in Spain, and we know about these issues, but what if something else is out there that we don't know about, that's not factored into the market? I can just say this, that the advanced decline, the market breadth studies are suggesting that this market is due for a correction. Now let's take a look at a daily basis here. You know, we have on a daily chart with the NASDAQ. And I think it's important to look at the NASDAQ because in a very strong economic environment, people start investing in several areas. Consumer discretionary. If the consumer has money and has a lot of confidence, he's going out spending. Coach, Tiffany, he's going out, he's buying flat screen 3D TVs, he's buying all new appliances. He's just going, they're going to top end stores. They're going to just be out spending money, right? Consumer discretionary is one. Financials, they start borrowing money, right, and start spending. Next, transportation. If you're a company and you have a lot of orders, you got to put it in a box and then ship it either by air, rail, or by truck. So it's got to be delivered. So transportation is going to be kind of an important sector to also look for confirmation. But also, if the economy and businesses are doing so well, they continue to invest in technology. And so the NASDAQ is kind of important in my research and work. And one of the things that we could sit there and look at is if we take a look at the July highs, we've had a significant breakout. Look at this. We can count the days. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. We're in our 14th trading week or 14th trading day or third week of this breakout rally. Typically markets, and you probably know this, in sideways ranges or in any type of breakouts, market breaks out and they generally come back to the point of breakout to retest that area. So it's a matter of what day of what week we see the correction. The next question becomes, what's the downside? So even if we come back to this 26.5 level, right, I think that's very possible. One of the things that I wanted to share with you as well is now let's take a look at the on-balance volume indicator on a day-to-day basis. And as I'm drawing this horizontal level in so that we can compare an apple to an apple, look where the levels that the rally ensued in the on-balance volume indicator over here, and where are we now that we've made significant higher highs. And as you can see, it's nowhere near the levels they were. So that's an area of concern. All right, does that mean I'm getting short and just loading the boat? No. But I definitely think that based on the implied volatility, and we'll cover this in just a few minutes, I definitely think it was important to share with you that right now, look where the NASDAQ, it's the strength of the market. It tends to see a little bit, it's holding the moving average values between the open-close relationship. It's still trading above both moving averages. We do not have a low-close doji. We don't even have a doji formation. So therefore, the NASDAQ is probably the key to this market. When the market does see a correction, focus in on the Russell, the small caps, because the leader of the game is going to be the one that the people, if you're in a winning trade and you have several stocks and several positions on, typically you dump the losers and you hold on to your gainers, right? So you want to hold on to those gainers. And so the strength of the market, the NASDAQ is probably the one that's going to take the longest to top out. But when it does, you want to sell the weakest sector or the weakest link in the chain. And truthfully, that would be in the small cap sector. And so you can go back and look at this by saying, how are we measuring what's strong and what's weak? Again, that's very important. How do you measure what's strong and what's weak? Well, where are the indices in relationship to their yearly highs? Where are the indices as they relate to new yearly highs? And if you take a look, the small caps aren't even near their yearly highs, where the S&Ps have broken out to new highs, and the NASDAQ's fairly close to their highs. So you can see on the chart itself that the small cap sector, and we'll bring this up one more time for you. And let me get a weekly chart going. Here we go. So if you take a look at the yearly highs that were made back in March, we're not quite at those highs like we are with the NASDAQ and the S&P. So therefore, if the market does give it up, it's the Russell that might tend to have the ability to go down further and faster. So there could be a couple plays that you could look at in the small cap sector. So I thought I'd just bring that to everyone's attention. Okay? So let's go back to our slideshow. And and I'm going to go and flip back and forth between the slideshow now, because a lot of what we talked about looking at the part of our work is confirmation, and it should be part of your work too. I mean, you don't just day trade. For example, I don't just like to look at day trading E-mini S&Ps by looking at just the E-mini S&P indicator. I look at to see if we have a sell signal confirmed by other sectors. So if we get a sell signal in the NASDAQ and a sell at the same time a sell signal in the Russell, the Dow, and the S&Ps, if everything's all firing in those sectors all at once, to me, it's a more formidable, more trustworthy sell signal. It tells me it's not maybe manipulated by local, it's not manipulated by traders and just isolated in the S&P, E-mini S&Ps, but it's more of a broad-based sell signal. And so that's what I would be looking at. I think if the markets are going to top out, right now the focus is to make sure that we see a decline consistent in all of the top 4 indices. That might be important information, and the reason I'm sharing that with you tonight is because I do think that we are headed for an impending correction. And I think most of you out there, if we took a poll, it was interesting because over the weekend I asked how many people think that the market was due for a correction, and there were a lot of people that thought the stock market was going to continue to go up. And 3 days later, we saw a mild pullback in the S&Ps. So I think it's important, A, to get your bearings straight and to use technical analysis to the best of its ability. We can only learn and apply and get information from an indicator and act on it if we understand what that indicator's job is designed to do. If you're looking at just a stochastics, a MACD, or just moving average studies, then you may be at a disadvantage. That's why in tonight's lesson and session, we wanted to explain, because we had one of the topics tonight was please go over current market scenarios. And so that's what we wanted to go through first off to cover that request. So let's get rocking and rolling here, because I hope everyone found the topic number one. If you're going to put on a trade, you got to be able to look at market direction. Understand where you're trying to figure out where a market might go. Ask yourself, or go start looking, where's the market been? And I think that might help people be grounded, because I know every day there's a lot of mixed opinions out there. You got to get in this market. You got to get long now. You're missing the opportunity. This thing could go higher. And so I think that it's best to say, listen, if the overall market is due for a correction, then I want to use some information other than someone's opinion. Hey, 13.8% year-to-date gains, it's a lot, but it could go to 17%, or it could go to 20% first. I want to know what's the condition and the health of the market, and what's the health of this rally. More importantly, what's the tendency, the supply-demand side of the market, what's its traditional seasonal tendencies headed after Labor Day weekend? What does the market typically do? And so from a seasonal perspective, we do see it goes down. From a rally perspective, we've seen mixed results on different indices on balance volume, and then we have mixed results there. And more importantly, we've seen that not all stocks are participating in this rally, and that, I think, is the biggest takeaway. Tops take longer to form than bottoms, and this is not something that you look to sell the first test of a downdraft after this type of a move. It's going to take time. So it might take another few days for this market to top out. I would suggest that if we do go up and test in the S&Ps, this is an important number, it's a line in the sand. If we do go back up and test that 27 level, which is the monthly pivot resistance, the person's pivot predicted resistance, 1427, if you go up there and test that area, then you want to look for intraday sell signals up at that level, and be aware that looking for end of day action. So if the market subtly closes lower than the open in a bull trend, even though we've seen very narrow open close relationships, folks, the market's been closing closer to the high, and it's been closing above the open. So when does a bull trend cease to exist? When bullish conditions stop showing up. What's a bullish condition? A green candle, right? Close greater than open. Close closer to the high. Close higher than past or prior highs. These are some of the clues that we start to look for. Is the market closing closer to the low? We're starting to see that right now, and we're starting to see a lot of indecision here, especially in the S&P, since today formed a doji, 2 days ago formed a doji. So there is a lot of indecision up in here right now. Okay? So just to let you know, this is educational in purpose, and the CFTC and the NFA would like me to make sure that you're aware that this disclosure is supplied. So there it is. Moving forward. Trading priorities. I think it's important whether you're an options trader, if you're doing iron condors, you want to make sure that the market, if you're doing any type of an option strategy, you should have some type of a directional idea. I think the market's going to move and contained in a range. Being in a range is a directional idea. It's sideways. You need to have an idea of where's the market, what areas can it go? Can it go up? Can it go down? And where has the market been? That's what we've just discussed. In order to figure out where a market might go, let's figure out where the market's been. Execution, your entry levels. What type of orders are you using? What type of products are you going to get in? And then management, what kind of stops or risk reward? You know, you might find that one of the things that I do, I play the let's make a deal game, the Monty Hall game. If my risk capital on this particular trade is X amount, where can I get bigger bang for my buck? Should I be selling futures, buying out of the money calls for protection? Would that work for me in a low implied vol market? Or should I be looking at maybe vertical bear put spreads if I'm bearish in the market? Where should my money go? How much money of working capital will give me a better rate of return for the amount of money I have to put up and the amount of risk I have to take? Remember, in futures, there's a margin requirement. So that's the money I have to put up. And as far as where your stop or what your risk amount is, that's different than what your margin requirement is. And then last but not least, position sizing. If I'm willing to risk X amount of money on that trade, should I be in 4 contracts of futures? Should I be in 8 contracts of futures? How many positions should I be in for the amount of risk that the trade requires? Not because I figured out, well, I only want to risk 15,000 on this trade. I need to know if I have an executable position and I understand where my stop or what my cutoff point of when I'm wrong is. It is at that point of knowing what that risk factor is, then I can start to calculate a position size. So your position size is measured against your risk, but your risk is measured on what the trade is telling you. So it's not just, oh, I'm risking 15 points. It can't be that cut and dry. You have to say, where should my stop go above a certain level or against a high or against a time frame? And if I'm risking so much money, then I should figure out how many positions I should be in. So, how do Person's pivots work? Most people know about pivot point analysis. Most people understand that you could have 3 targets of resistance and 3 targets of support, and of course the midpoints. So if you did that, then you would have almost 13 lines of support and resistance across your screen. What we came and did was we put together a 1 period and 3 period pivot point moving average. And so that when the 1 period crossed above a 3 period, it would then generate a bullish environment. What's neat is when we were in a bullish environment, it would give us and filter out 1 resistance, which in this chart is the bonds, which would be in red, and 1 support, which is in green. Notice that when the market is bullish, you see each corresponding or the next time period showing a higher green and a higher red. And that means that the market's bullish. If the market's bullish, the blue horizontal line going across your screen, the blue line is above the gold line. And so every time you see a blue line above a gold line, then it would filter out what the condition of the market is in. Blue above gold, it was bullish. And almost every time, at least in this example, which is this year in the bonds, we would see the market still maintain that bullish bias to the upside, and it would accurately give us almost the entire range of the time frame that we were in. So that's an interesting concept. How can we apply that to making money in the marketplace? Well, what's interesting is if you're understanding, is the market, is this bullish trend, is it sustainable? Can it move higher? Well, first thing I'd like to know is it moving with higher volume? Are we seeing volume breaking out? And in on-balance volume, one of the things that we have here is a moving average, which helps us to uncover, putting an indicator on top of an indicator, is the market moving in conjunction with a trend up in the moving average of the volume? And the answer is yes. So if that's the case, I could say to myself, gee, that means when the market pulls back to the support area, I can probably place long bets. So if we pull back to the pivot point, I could probably bet that by the end of that time period, the market could go up. So what we're looking at in the slideshow here, and everyone should see a bond chart in front of them, correct? Okay, so if you've seen me drawing on a chart, then you're on the right chart. Okay. All right, so what we're trying to suggest is that if you're going to use a binary option, or if you're going to use an option, you have to understand what's the direction of the market. Makes sense, right? An indicator that could be fairly accurate, say more than 50, 60%, if it's accurate in saying here's what the condition of the market is, when a market pulls back to the predicted support, if you can say, gee, by the end of the time period it might be close to resistance, maybe I could look at buying a specific strike price, or maybe I could look at betting that the market's going to be higher from where it is right now. Does that make sense? So basically, when the 1 period pivot point is above a 3 period, we're in a bullish target environment. And as soon as we get that information that the market has changed and that we're near support, we can say, gee, I don't know if it's going to get all the way up there, but it certainly should be higher than this value area between the support and the pivot point. Okay? So as the market trades close to the pivot point and it holds, you can bet that the market's going to go up. If the market pulls back to support, you can bet that the market can go up. If the market pulls back to support, you can bet that the market's going up. So you get the idea that in a bullish environment to buy pullbacks. The hard part is to define what the heck is a pullback. And what we have for you is a pullback written by the pivot point. So if the market pulls back to the pivot point, then you can make an assumption the market should go up. At least to what area? Resistance, target levels. Okay? Now, in a bearish environment, the opposite is true. If we get a crossover, if the blue is below the gold, if the pivot point falls below the 3 period pivot point moving average, then my indicator filters out for us, number one, you're going to get a lower high and you're going to get a lower low predicted range. So that means that through the course of the day or the night, as the market trades close to the resistance, I can now make a bet saying we at least should be below the pivot by the time of the end of this time period. So if Person's Pivots is worth anything, it should give us A, the trend direction is down based on a series of moving average. When the blue line is below the gold line, then the market is deemed to be bearish. So you should be on slide number 9 with me. And I'm drawing on the line. And this is number 9. So it's interesting because some people are saying it and some people aren't. That's interesting. So that must be technology. I'm not sure if you need to refresh. Okay. So some people have it and some people don't. All right. So how and when to use certain options? And how do you get Person's Pivots? Many of you have TradeStation or Genesis or Thinkorswim. Thinkorswim has my indicators up there. Just look under John Person under Studies. The Person's Pivot indicators are available on a lot of different platforms. Okay? Directional option plays. When do we like to use directional option plays? When we have a lot of evidence that suggests that the market's getting ready to move. Okay? And then we act on a signal. So that's where seasonality comes into play for us, at least for me. And then when I get a Person's Pivot study, PPS, a sell signal on the charts that confirms the momentum has changed in the downside, then I'm looking for more directional strategies. Okay? Depending on the market environment as well. How is implied volatility? All of these things play a role as to making the business decision of what's the best strategy. Obviously, if you're right, there's no other strategy on the face of this planet that can provide, with limited risk, an incredible profit opportunity than an outright long put or a long call. Bottoms, hands down. That's it. But timing it, that's why 80% of people that do that, they lose money because their timing is off. So I think it's, when you're playing a directional play, number one, you got to have your ducks in a row. You have to have some very good timing elements on your side. And then the next thing is you got to have options within what we call the realm of reality. And more importantly, I think instead of just having one devoted strategy, maybe mix it up a bit and have different strategies for directional play. So in case your timing is off, in case your strike price is off, or the market doesn't move as you had thought, which can happen, or the market moves a lot further than it you think. And that happens a lot in this industry, as you've probably all experienced. So I think that's why we like to look at certain strategies and why I like to look at bear and bull spreads. So when it comes to directional, and just to cover this information, because the slides that we're covering right now were some of the questions that we had when it pertained to those who had purchased our options trading course on binaries as well as options. Remember, the shorter term your horizon, the higher the delta should be. If you're a day trader, you want a high delta. I mean, you want an in-the-money option, high delta. You want day traders. You want to be underlying, buying in-the-money options. And, of course, if you're an intermediate-term player, 3 months or less, you want to buy near-the-money options, slightly out of the money. One of the things that I like to look at is, of course, in the deltas. And we take a look at deltas on puts, which is a negative value, and deltas on calls, which is a positive value. And I think one of the aspects of options trading is everyone looks at, what the options theoretical pricing is. And remember, options theoretical pricing will change based on the condition of the markets. So when you price your option strategy out based on today's volatility and today's option pricing models, if things change, those options are going to change rapidly. And those values will implode or explode either way. And I think that's one of the things that a lot of traders struggle with, is even Myron Scholes didn't know how to predict volatility. We've seen the VIX, which has been a lot of, I know a lot of you folks are trading out here and watching options, but the VIX trading near 13.5 the other day, we've seen some really wide swings in the VIX at such a low level, it's still moving on a high percentage term. So there has been some volatility come in the market in the last few days that I think is also different and a unique way of examining market conditions. So as we start to go from a phase of low volatility to increased volatility, we have an old phrase in the business: volatility marks tops and bottoms of the marketplace. And that's why no strategy works every and all the time. No strategy. If you're only locked into doing one strategy, market conditions change, volatilities change, and you need to adapt and change. And by the way, that's why the person's pivot is such an amazing indicator, because it adapts and changes with market conditions. So when we have narrow range days, or when we have wide range days, and we have the markets go from bull trends to neutral phases to bear trends, the person's pivots adapts with these market conditional changes. And that's one of the things that it moves, because the one constant that change is volatility. And guess what? Because of that, person's pivots also adapts with the change in price and volatilities. Now, just as a rule of thumb, for those that are interested in options, whether they're binaries, if implied volatility is low, options are cheap. And that's what's going on right now. With a low volatility, options are cheap. So it makes option writing strategies that less interesting. When IV is high, options are expensive, which makes, in a high volatility environment, buying out of the money options a less than desirable strategy. So you got to pay attention to what's happening with the IV, implied volatility. Again, when IV increases, options get more expensive. Many of you already know this. But what strategies would we use when volatility is high? Covered call writing strategies, because you're getting a lot more premium built up in a higher IV period. Writing naked puts on stocks you want to own. Nothing better in a high volatile market when the market's crashing and you want to own a stock than selling out of the money puts, because you can collect richer premiums in a higher implied volatility. It's a lot easier to sell an out of the money put for a high price tag in a declining stock market than a rising or stable stock market, because no one in their right minds wants to take the other side of that trade, right? So by selling and writing an out of the money put, you're going to get a lot of premium, but you got to make sure, if you're doing that game, that you want to own stocks and your horizon is a little bit longer. And that's where seasonal analysis can really help. When we come into October, November, after the elections come through, depending on the markets, I'll tell you what, it's going to be an interesting options game. I think next year, and coming after this election and into 2013, folks, trade up, train up, get your pencil sharpened, Get your equity in order, because I think we come into a new era of trading. Whichever way the chips fall, Dems or Republicans, it's going to be an exciting remainder of the year and first half of 2013. So when volatility is high, credit spreads. Credit spreads are very important when volatility is high. It's a defined risk strategy. Higher priced options, you can do credit. When you think the market's topping out, you do credit call spreads. Very important strategy to employ in your trading approach. Again, diversification is the key to success, but no one said you needed to diversify against different markets, but you can diversify in your strategies, and that's one of the important things, and the products that you're going to use. When volatility is low, which it is right now, buying underlying stock. Right now it's tough to buy underlying stocks, but we just shared with you the advanced decline line, right? The advanced decline line suggests that there's not a lot of stocks, or not all stocks are participating in this rally. I mean, look at in the tech space, we see the NASDAQ moving up, but look at EMC, look at Microsoft. It's not breaking out to newer highs for the year, are they? No. So there's a lot of stocks that aren't participating with this move. So I guess the argument is, if the market does correct, those stocks, if they correct even lower, it'll be a better time to be buying underlying stock. My favorite right now in this environment, debit spreads. Debit spreads. In not a credit, but debit spreads. If we're looking for an impending correction in the market because we're in a low volatility time period and you want to get through some time, and also look for at least reasonable strikes. If you're into diamonds, the 131, 129, a 1x2, those strike price levels might be appropriate. It's fairly close to the money, and you still have about 30 days left to expiration, or 29 days after today, to get you into the September expiration for very limited amount of money down. If we do see the turn this week, then I think you're going to be looking at a chance to get in a close to the money, a narrow corrective phase into September. So, and also, since implied volatility is cheap, buying puts for protection now is real inexpensive. So, that's using regular options. And we're in an environment that, in putting things together and bringing it home for you, we just looked at the overall stock market. We talked about where we are with some timing tools that we use, i.e. on balance volume, AD lines, as it relates to individual indexes. Many people only look at the AD lines as it resorts to, or as it points towards the NYSE, New York Stock Exchange Composite Index. So I just shared with you specific AD lines for each individual stock indice. And so we have a good argument and seasonal aspect, looking at history, that we do come into a time period that the market pulls back. So if that's the case, we're near monthly pivot resistance, and it's also the situation that we see perhaps that maybe we want to take trades day by day. When things do turn and we are more in a confirmed bear trend reversal, then I think using a binary option might be something, especially in an environment that we go from what? A trend, and then sometimes we go through a little consolidation phase, and then we reverse or resume the trend. And I think right now you could probably guess that we're in a consolidation or at least congestive phase on a day-to-day basis right now. I mean, we made a new high, we rejected it, we made a new 3-day low, and it snapped right back. So if you take a look at where the market's closed in the last few days, it's been, you know, since the 16th, which the 16th was last Thursday. So Thursday, Friday, Monday, Tuesday, and today, 5 trading days, we haven't budged on the close, but we've traded both sides high and low. That to me is a sideways movement. So we are in a, that's what I mean, we're in a correct, that's what I define as a corrective phase. So here's the deal. If we're going to correct and then get ready to reverse to the downside, here's an instrument that you can look at, especially if you have a rule-based system. But if you lack a little discipline, you get a bit nervous, you change your mind a lot, then using the benefit of binary options is fairly important. The website that you can go directly to is nadex.com, number one. And I'm going to go over here to desktop, okay? And basically, you can look at different indices on binaries. And let me go over back here real quick for you. We're going on to the slideshow first. All right. So let's say, for example, we have our pivot point analysis. And we're still in kind of a corrective phase, but we might be short-term bullish over the next few days. Number one, we got some really interesting aspects here for people. If, number one, you feel that the market is coming close to your daily support areas, and you can say, gee, we might actually, with a signal, since we are in a bullish day, we could trade up, back up to the pivot area. So you could look at a binary option strike price. The key is, number one, to try to find something that has at least a 1 to 3 risk-reward ratio. Now, Jay says, normal person should never touch binary options since its bid-ask spread was horrendous. Well, they've really cleaned up the bid and ask. And Jay, I think absolutely that's a great statement. I want to applaud you for that, because, folks, if the trade does not fall within your category or your rules, don't do the trade. If you can't, I never suggest anyone to go to the market. Work bids. If the bid ask is a little tight, too tight, or it's too narrow, you know what? That's a great market. It's more liquid. If the bid asks are too wide, it's more illiquid. So, you know, you need to work orders. With the neat thing about binary options, you're looking at a specific movement in a specific period of time and still using the strike price concept. So if I think that the market might be above 46 or 48 on the close, then I could look at buying a binary option. The notional value is $100. The maximum I can make is $100. So it's up to what I can pay for that. So if I pay for $30 for the right for the market to move up, if on the close of business it does move above my strike price, then I'm going to get $100. But if it costs me $30, then my net gain is $70. So again, it's really an intriguing idea that if you're sitting there as a trader and you're saying, gee, I might not get a lot out of this trade, and I don't want to do a regular option because there's too much expiration, but I can take this one day at a time. Looking at the Nadex binary options in time, as you explore that, if you've never done it before, you may find a way of compiling information and compiling a trade. So, for example, Jay, when you say the bid ask is horrendous. I mean, if you're going to look at a strike price on a binary, for example, as we have here at $22 bid and it's $25.50 offer, if I split the bid ask down the middle, okay, and I want to go, say, $24 and wait to see if my bid changes and I get picked off, great. If I don't think that between $22 and $25 is a big deal, $3, then I'll just buy the offer. So I've got at least to buy the binary that the market will close above this level, right, into the close, then guess what? If my indicator is accurate, or at least more times than not right, if the market does push off, per position, I'm only risking $25.50 if I hit the offer and went long and bought on the offer. So on this chart, you can see with the thing about even using Nadex, they have charting capabilities, and you can track the actual value of the binary option, which is pretty neat. So if at the time we get our little buy signal, we buy that option for, say, $25, by the close, we get paid. Now, commissions are $1.25 in and $1.25 out if it makes money. There's no commission if you lose. And they've just lowered that commission on Nadex, by the way. So there's a really neat feature about the commission rates, especially if you're doing size, 10 and more lots per trade. So the fact is that if I'm only risking X amount of dollars on the trade, I can make the decision if the market does move in my favor, I can make the decision to do that trade or not. So, in fact, here's the results of that trade. This was when we got the buy signal, and we were betting that the market could just get to the pivot. We were betting that the market would get above that 46.90 area, and so we can make the determination. Now, would it have been better to buy a futures? Well, you know, if you think that the market's really going to tear off, maybe you buy a futures. But if you're just looking for a small risk-reward ratio, that you're looking for the market to move in that general direction, then the binary options is a great feature for those that are utilizing this type of technical analysis, especially when we have our person's pivots. Now, here's another thing. I shared this before, and I want to share it again, because I think it's important that for those people who are using person's pivots, how does binaries work? Number one, and how does person's pivots work? Well, binaries work that you're going to bet money that the market will be at or below a specific level. So I can buy a call and I can actually sell a call. If I believe the market will be lower than that level, instead of buying the call, I can sell the call, right? And so I still have a defined risk. You can do spreads. There's all types of avenues that you can do with the binary options. The key is for those traders that are looking at a weekly basis, and I'm using the S&P 500 here, which Genesis Trade Navigator did a back test. These are their results, not mine. What we took was, what is the relationship, or the in the last 3 years, what has the person's pivots, the accuracy rate? It's been 83.75% accurate in detecting the weekly trend direction. That's pretty good. Bearish was not so good. It was a little bit lower. So one of the things that we could suggest is that, and if you understand how this works, now I'm not saying to go out and 69% on a bearish binary. So for whatever reason, it's been, maybe because in the last 3 years the market's been more bullish than it has been bearish, okay? So that might have a lot to do with why the bullish binary outlook, or at least the codes, were a little bit better. So what we were asking, and what the scan and the results say, is that if the market is bullish, then the market closes above the predicted support. So when the market comes on a bullish predicted day or a bullish predicted week, if the market trades near support, then you look to buy a close to the money binary call. And as the market moves off that level, guess what? Your binary value will increase as well. So I think for those traders who are a little skeptical of the market, but may want to put some ideas to work, the binaries using person's pivots has seen some pretty interesting results. Now, here are the daily backtest results that they did, which are a little bit different than the weekly. The daily was close to the weekly results in the fact that we had 84.25%, and on the bearish daily was 74.75, almost 75%. So if you can see, if the market is bearish, as person pivots indicate, it's going to suggest that the market's going to stay below the resistance target, and trend lower. So let's say it's a bearish day and the market rallies to resistance. When it gets to resistance, you could start to look at selling a binary call, or the right to say, I think the market will close below this level. So in the last few days, you can always check, and we'll put that up for you, which is kind of interesting. I'm going to put up just to see where the market's been in the last, say, week and a half, and I'm going to go over here so that if you have been using person's pivots on TOS, on Thinkorswim, then, or if you haven't, more importantly, it's a strong argument of why you might want to look at doing so. So I'm going to get rid of some trend lines that I put up. And I don't want to ruin the integrity of the presentation. So everyone should see my chart again live. Okay? Is everyone seeing the chart? So if the blue is above the gold, the market's bullish. So every time we get near, this is a 360-minute. These are the daily charts. So as you can see, going back since pretty much the beginning or the midpoint of August. So every time the market on a bullish day we've traded near support, it closes above that level. Gets to support, closes above that level. Gets near support, closes above that level. I mean, even today did the same thing. Today was deemed to be, believe it or not, blue above gold, a bullish day. The market came near predicted support, bounced off of it. So if you can, when the market, now this is the problem. The one problem is execution. Remember, that was bullet point number 2 on our beginning of our presentation. You might not get filled. You might not get filled for several reasons. You worked bids and the market didn't get down to your bid. B, you weren't in front of your computer screen because you're doing another job. So that's where using maybe weeklies and looking at end-of-day data and putting in some type of theoretical value, a low ball on a bid to see if you got hit. You know what your risk is, and by Friday, if the market closes, guess what? On a weekly expiration, if it closes higher than your strike, you can make money on that trade. Now, these are like American exercising options. You do not have to hold to the close. So let's say I buy an option for $22. Let's go over to Nadex real quick, just so that we can take a look at this. If, let's say, for example, I look at a binary option, and I want to look at the S&P 500, and I want to look at a daily for tomorrow, okay? And I think tomorrow we're going to close above by 415. Odds favor, we might close, let's say, all right, at this point in time, a 14.15 strike price. If I say I think the market, you got a 45% chance of being right. That's what the market's telling me right now. It's bid 51, it's offered 55. There's a $4 bid nest. Well, now it's a little bit more. So let's say, for example, I think the market's going to rally or at least be above 14.15 tomorrow. If I buy that right now for $56, and let's say tomorrow morning at 7:30, we wake up, we come into the game, and we're sitting here at 7:30 Eastern, let's say 6:30 Central, and you turn on your computer and you see the market's trading at 21. That value of that option is going to go up. I don't have to wait until the 4:15 close to exit. I'm not going to get all the profit that's due, but I might see an appreciation in the value of the option. So one of the things that's interesting about Nadex is I can place a bet with a defined risk and then look at the bid and the ask. Bid's 51, the offer's 52. So the bid ask, I don't have to hit the offer if I don't want to. I can actually go ahead and place limit orders. And I think that's one of the neat things about the market. You're dealing with binary options. The concept was great. It's about time they had a regulated exchange doing this. And the fact that you can deal directly through Nadex. That's one of the premier benefits of doing this. I would not suggest anyone to do anything like that if I thought we were going to have another, and you know what, I can't guarantee that there's not going to be another MF global blow up, but I can tell you this, if there is, there'll be heads to roll at the CFTC if there hasn't been already. So there's been a lot of new changes that have come into play, and I think from a regulatory standpoint to ensure customer satisfaction. This is a U.S. company. It's a U.S. exchange regulated by the CFTC. I would not tell you to go with, I don't know, about these other brokers and opening an account and sending my money to Cyprus. I don't know anything about that. But I do know that through Nadex, you have an opportunity to currently use the tools at hand and how we can use, and if you found person pivots, and we have a lot of students in the audience tonight. We have a lot of people that are very fond of the indicator that we created over a decade ago, believe it or not. And, it's a very powerful indicator. It's just how do we use it? The markets, you're going to have a lot of times where you've got great ideas and you've put a lot of homework together and you've got that decision-making process and you place your orders in the market, for example, in the S&Ps. You want to put a bid in the market, it hits you. If you're trying to buy the S&Ps, let's say at 4 1/4 and it's at 4 1/2 and it pulls back and it's 4 1/4, 4 1/2, 4 1/4, 4 1/2, 4 1/4, 4 1/2. All of a sudden it's 4 1/2, 75. Next thing you know, you're trading at 14.08. You're unable. Sometimes it does happen that you miss a trade and that you don't get picked up. So that's why there will be execution issues. You're not going to be there for every single trade, but if you can stack the odds in your favor, and what I'm saying is with Person's pivots, if the power and the predictability has decent back-testable results, how do you apply it to a binary option? How do you apply it to regular options? When are you using these different strategies? I think that's what's important, to kind of mix it up. You've got some options working for you right now, maybe longer term, and I want to maybe trade some options for maybe to see how these markets trade for the end of the day or the end of the week. I can tell you this, that if we get up near weekly resistance, I'll probably be looking at selling calls up there because I think it's more likely that we see a correction from the highs. Any further gains up from here as we test the high that we just established, any further gains from here will probably be very short-lived, especially seeing the market internals that I've just shared with you. So hopefully we shed light on how it's beneficial to put the Person's pivots together and how you can utilize it for other derivative instruments such as options and binary options through Nadex. So it's just if you're not familiar with them, at least tonight's session was a nice way to introduce you to them. You can find out more information. We had a lot of really good questions tonight. We had, hey, these things are a ripoff with brokers. Hey, these things don't have tight bid and ask. And you know what? We've just showed that they do have a regulated exchange here, Nadex.com, number one. And we did show that they have fairly decent bid and ask. No one said that you had to buy the asks. You can work limit orders. So, Zoltan, yes. But Cyprus, I know, is an island, but it's also a tax haven. There's a lot of people that were, the binary options have been around a while, and Cyprus was a big place for you to deposit where these places were located. So I keep picking on Cyprus because that's where these things were. It was kind of like the old days with Forex, where you had offshore Forex dealers, and back in the day, well, it's kind of been cleaned up, and there might be a place for it. So anyway, binary options, hopefully we answered your questions with that tonight. It helps you let winners run. It helps you to cut your losers. If you're disciplined, you put on the trade. And, another thing is, if you see an immediate result, you don't have to wait till the close. You can get out of it. And it helps you to zone in on a derivative product with high probability setups. So that is one of the ways that I think, if you're interested, we did a course on options, and we had this on special several weeks ago. And many people took advantage of this. We've not released, you've not seen advertisements on the option course. We've not released it to the public. We haven't done a big promotional piece on it. It's on the website for $9.89. If you're interested in taking advantage of it, by clicking this link, you go to our website and it get right on that page, and you can. It says $9.89, and when you click View More, it has the discounted price right there for $4.89. If you're really interested in this, because we are doing a big promotion, we're going to start with this next week into the Labor Day. We're going to be doing a promotion on this course, but unfortunately, when we do the promotion, it's going to be $9.89. So we are letting a publisher company promote this, and so it is going to the full value in, I think it's 10 days, 2 weeks. So this week we've got to pull it off. So if you are interested in taking advantage and learning more about what's in this course, it's, explains more about person's pivots, seasonalities of all the top markets. If you have the Commodity Traders Almanac, it includes latest charts on supply demand of the graphs for all the markets. In fact, it goes into the volume, the on-balance volume, how to use that as trend confirmation, how to get into our pivots, and information that you may not have had before. So if you've never done this, it's a great offer. Appreciation for those who have had my work before. I think this would be a really nice product to study, to have. It's a great product, to be truthful, and it's an incredible value. So if you're interested, click on that link, and they're excellent tools. The PPS is an excellent momentum indicator. Click on that link if you're interested. This will expire, and I've just explained it's not a fluff marketing. It's going out to a publishing company that is going to promote it, and so you will probably see it offered for $9.89. But if you're interested tonight and this weekend, it's $4.89. We'll keep that up there. So thank you all very much for that. All right. If you had any questions, you can certainly send us emails at johnp@personsplanet.com.